We are still much on FX risk management. And remember, we said to manage FX risk, usually you can be using internal method or external method. We've been looking at external method for some time now. Things like forward, money market edge, futures, options. The last video actually focused on options. And now we're looking at swaps. So this is done, 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 and done. Now we finish FX risk management with swaps, which is quite short. So now I'm going to be looking at swaps. How do we use swaps to manage our FX risk exposure? First of all, you need to know there are two types of this. Please take note, and they are totally different. The first type is the Forex swap, and the other one is the currency swap. And this differs based on the objective, that is what the company is trying to mitigate, the situation of the company. Why would a company wants to use Forex exposure? I mean, Forex swaps. Usually, this is necessary or comes handy when the company is struggling to borrow in foreign currency. So this one is just for the company to have, I'll say, for access to foreign borrowing, foreign currency borrowing. Yeah, usually that the company will not be able to get. So let's say not normally available. Maybe because of credit rating or because of restrictions or whatever it is. That is when the company most likely will decide to use Forex swap. However, if the objective of the company is to look for cheap foreign loan, you see, different thing. The access is there, but definitely it should be more expensive as a foreign company. Think about it. If you are a company based in the UK and you want to borrow money in Australia, your rate will be different from an Australian company that resides in Australia that is trying to borrow within Australia, because there is a inter jurisdiction. And because of that locational international difference, then there's an additional risk that will be attached to that borrower. And because of that, your borrowing rate will be different. And in that case, a currency swap will help you in that space. So this one is used to swap interest rates. I'm going to explain how this both of them work. This is just a way to swap interest rate in different currencies. Yeah. And what do you get? Most likely, what you're looking for is a cheaper foreign loan. So this one is about accessibility. And this one is about cost, interest rate. No, that is the cost of loan. Right. Yeah, so I'm going to use example to just drive this home quickly. This is very easy. What we're saying here is that you need two parties. A needs the currency of B, and they go into swap agreement, they fix rate, they swap money, principal. A gives B his currency, B gives A his own currency on day one. And expiry, they swap back. That's all we're saying. B returns the money, A returns the money. Same fixed rate. It's as simple. That's what we're saying. But it's different for currency swap, because for currency swap, A will help B to take loan in his own currency. So A will give B loan itself, the loan amount. Yeah. A will be paying the bank interest. Yeah. However, B will have to refund A of that interest. And the same thing A will be doing for B, B will do for A. So B will also help A to borrow money in his own currency. B will be servicing the interest in his country. However, A will have to refund that money back to B. So they are helping each other. So you can see in currency, both principal and interest are relevant. But here, our focus is just on principal swap. Just to make you see the difference easily. Okay? Take 1 second to digest that. Now let's look at the question for both of them just to help you so that you can have a better grasp of what we're talking about. Look at this question. It's on Forex swap. I'm going to be using this question to explain what we've been talking about for Forex swap. You have Usman that wants to go to Pakistan to build a school. Usman is a UK company, so which means Usman does not have rupees, but he's lucky that the government of Pakistan has agreed to swap 100 million for 5 million pounds. Because if you look at it, the current spot rate was the agreed rate. So first of all, you need the swap rate that has been agreed. This swap rate will be used both at the beginning and at the end, such that the amount will not be different. That's why they always fix it. So in this question, that rate has been agreed to be 20 rupees for every pound. So which means we try to break it down. Let's say we have Usman here, and I'll just put government here. But my focus is on Usman, which is the company that is trying to use the hedging method, right? On day one, what's going to happen? Day one, Usman will have to borrow in local currency because he needs 100 rupees on day one, and 20 rupees is 1 pound, so which means the total amount that he will need to be able to do his swap, he needs to swap in his own currency for what he wants. That will be equivalent to 5 million pounds. Yeah, that is 100 million rupees. So if he's going to get 100 million rupees from the government, he must be able to give government 5 million pounds, government of Pakistan. But remember, you don't use your money for all these transactions because without your money, you won't need all this edge anyway. So you have to go and borrow money. So he needs to borrow 5 million. So he's going to borrow 5 million and give it to Pakistani government. So which means he's going to leave 5 million and he's going to give it to these guys. Likewise, government will have to let go of, so let's say we have two currency column, one for pounds and one for rupee. Let's do the same thing here for pounds and for rupee. So same day, government will also need to let go of 100 million rupees and they will give it to Mr. Usman, who's trying to build a school. So on day one, you can see that Usman already has the money that he needs for his investment. And this particularly is important because remember that he doesn't have to buy foreign currency at the expiry date because he's doing this strategy because he knows that he's going to get 100, 200 million actually. So from this, he can actually pay back the you can close the swap. Yeah, without necessarily having to buy currency and having more exposure. So that is day one. The swap already in existence. No interest is paid. Next thing is you wait to expire. So 2 years time, few things will happen. Number one is that they need to close the swap. So which means they swap again. Yeah. So what we're saying is they reverse the initial swap. So which means this time around, Usman will be the one that will receive 5 million pounds from the government, and he would have received his 200 million from the sale of the school. Out of that, he will have to give the government 100 million rupee back. Government will also pay him back his 5 million pounds, and they receive their 100 million. You can see this comes to zero for government. Our focus is on this guy, Usman. Remember, it doesn't end here for Usman. There are two things left. The second one, after the first one we've spoken about, is the fact that he will need to convert the excess money. Unfortunately for him, on this date, after 2 years, rupee has gone to 41 pound. So which means that 100 million rupee will now be worth just 2.5 million pounds. You see, guy is lucky that he actually edged. So see more because he also borrowed. Remember, the 5 million was borrowed for 2 years, and they gave us the interest rate in the UK at 10%. So he's going to pay interest at 10% for 2 years over the amount of 5 million that he borrowed. And that means he's still going to pay an extra 1 million. So invariably, you will discover that it's still better off. Rupee comes to zero, and his local currency still gives him additional 1.5 million left. That is what Forex swap is all about. It's pretty straightforward. You're just swapping at the beginning and at the end at the same fixed rate. And remember, in the middle, at the end of the contract, you need to find out how much interest expense the company will pay because you will always have to borrow your first swap. That's the major thing. It's not the time you're going to have excess, but if you have excess as well, you need to know that that will be done at the spot rate. Excess is just like unhedged portion. That's what we always say, that you need to know, be careful, because you might always have unhedged portion of your exposure. And if it's unhedged, then it will have to be executed at the market spot rate. Whatever the market spot rate is talking about, that will be your reality. Let's look at another question for currency swap. So that is for Forex swap. Let's look at currency swap. So you can take 1 minute to look at this question. Very interesting one. This is on currency swap. Remember what I said. Currency swap is a way to look for cheap foreign loan. And if you had read this scenario that I have here, you discover that if one is trying to go to Euro by himself to borrow, he will have to borrow at 5.6. But if Eurospot helps him to borrow, he'll be able to get the same loan at 5.5. Same thing applicable to Eurospot. If Eurospot decides to go and borrow by himself in Australia, he will have to pay at 7.2%. However, if he's smart enough to use currency swap, one can actually borrow for him at 7%, much cheaper. Now, let's look at the dynamics. How does this work for the two companies? How do they set this up? Remember, initiation, this is a swap. And at initiation, said both principal will be swapped as well. It's not just interest, it's not just principal. In this currency swap, both principal and interest are swapped. And how does it work? What will happen? Let's break this into two sections. So let me put one here, one co, and I'll put Eurospot here. Yeah. So now we're talking of initiation. What is going to happen on day one? That's what we're saying. Day one. Because one will have to help Eurospot will have to help one. But what we know is that what one needs, this guy needs 24 million euros. Eurospot needs 40 million Australian dollars. He doesn't want to go to Australia to get it because of the rate will be 7.2%. This guy too doesn't want to go to Europe to get it himself because if he tries to do that, he will need to pay at 5.6%. Now, they approached each other and they agreed to do a foreign currency swap. Okay, what does this mean for both of them? On day one, means that one co will have to borrow. So this guy borrows on behalf of Eurospot. He doesn't have to tell the bank that he's borrowing for Eurospot. He just get it himself. So he borrows that. The same thing Eurospot will do, trying to help his brother. It will have to borrow what one needs. 24 million. You can see they've helped each other to borrow. Once they borrow it, they swap. So the swap starts immediately on day one, which means one gives Eurospot the money they borrowed for him, 40 million, and in return, he will receive 24 million euro from Eurospot. Similarly, you have the same thing going on the other side because Eurospot, yes, Eurospot will have to hand over this money to one. Gives 24 million euro to one co. Yeah, that's this. And he will receives the money that he has been praying for, 40 million Australian dollars. Yeah, I'm talking about Eurospot here. Don't confuse it with currency. Okay, you can see that is the swap on day one that's happened. This goes to this guy, this comes to this guy. They've swapped. And that is day one. They will have to be servicing the loan. Yeah, if you pay interest, the loan you have collected, because the bank does not know that one has collected loan for anybody. So one will have to pay interest. So which means, let's say this is for 1 year. You have assigned the question. So after 1 year, yeah, assume the interest is paid end of the year. Yeah, that's just going to be the case anyway. To simplify the scenario. Okay? Remember, what is important for us to get the understanding. So after 1 year, one will have to pay interest for sure. So which means, but you'll be paying that interest at 7%. Yeah. Likewise, Eurosport will pay interest on Euro loan, but 5.5%. So which means after 1 year, Mr. One pays his bank. at 7%. And that will be equivalent to just Australian dollars of 2.8 million. Euro spot on the other end as well, we have to pay his own bank too. The interest on the loan he collected. Also at a cheaper rate, which is 5.5%. That is equivalent to just 1.32 million euro. Then the next thing again is swap the interest. So this is followed by interest swap. Remember, they initially swap the principal, now interest swap follows. And what is going to happen? You can already know because it's a refund session, which means that one will have to refund Eurospot. So one pays Eurospot just 1.32 million euros. So that's a refund for this. Yeah, let me use different color. That's a refund. It's trying to refund him of this. Likewise, Eurosport will have to refund one as well because the same swap will happen here, and what's going to happen is that Eurosport refunds one, that amount that he paid on his behalf, and that is 2.8 million Australian dollars. With that, they have swapped. You will discover that invariably, what you are saying is that this guy has been compensated for this. He got a refund through this. Likewise, this guy has been compensated for this because he got a refund. So invariably, what we're saying is that the net interest that these guys have paid is that this guy has paid 1.32 million interest, and this guy has paid 2.8 million Australian dollars. And imagine if they had not done this guy would have paid at 7.2%. Yeah. In fact, let me finish before I show you that so that you don't confuse it. Let's just finish. So, interestingly, we're done with the interest swap, but they cannot close it because they also need to still swap the principal to fully close the contract. So the next thing is principal swap. So principal is swap both at the beginning and at the end. Yeah. So principal swap, yeah, to close, not to initiate. Remember, they do to initiate and they also do to close. So in that case, it means that Eurosport will have to give one the money that he handed over to him at the beginning. So, and one will do the same thing. So one gives Eurosport the principal, which is 24 million euros. Eurosport will do the same thing. The 40 million Australian dollars that he borrowed for him. And once that is done, one can now, because this money is coming to one, so one will repay the bank. Yeah. And likewise, Eurosport can repay the bank. And the whole thing is closed. So Eurosport will repay the bank is 24 million, and one will repay the bank is 40 million Australian dollars. And that is it. That is currency swap. And like I was saying, look at how much they paid. Let's see, without edge, how much would these guys have paid without edging? It means that 24 million that he borrowed, he would have paid at 5.6%. And that would have been equals to 1.344. So that is equals to 1.344 million. That's what he would have paid instead of 1.32. And the other guy would have paid at 7.2% of 40 million Australian dollars, which would have been 2.88 Australian dollars. Savings, easy, we can see it. That is equals to 1.344 minus 1.32. Remember, 1.32 is 2.8. 1.32. And this guy, the savings will have been 2.88 minus 2.8, which means this guy was able to save 24,000 euros. And this guy was able to save 80,000 Australian dollars. That's how much they are able to save by hedging. So that is it. Basic understanding. Very good, straightforward. And that actually marks the end of FX risk management. The next series, we'll start looking at interest rate management. And the same strategy we're going to be using. We're going to be talking about forwards, future, options, and swaps. But this time around, the underlying will be interest rate.